What's happening, y'all? Christopher Griffith, and I have my good friend Hammer here today. We wanted to hop on this morning and chat with y'all about a few things, and I see y'all asking questions about all the time. Everyone's always curious, hey, where are interest rates? Well, when you have hundreds of companies posting stuff all over the place and just sizing their own profit margins, interest rates that you experience could be everywhere. But what causes movement there, right? So we want to start coming on and bringing some of my friends on here regularly to visit with y'all and help to explain some of the finer points of movement as far as what's going on, what causes things to change, and then what to watch for maybe this week, what you can expect, sort of thing. So without any ado, Hammer, why don't you introduce yourself, brother?
Good morning, everybody. My name is Hammer. I've been in the mortgage business for about 20 years, and the last 10 of that, I have spent a lot of time helping mortgage professionals understand where the markets are going and where interest rates are headed. And together, we like to take that to you as consumers so that you guys can be armed with information and understand which direction things are going and why.
So in a shorter way, Hammer's a guy that mortgage people pay to get texts and emails and calls that say rate alert lock or rate alert float, those types of things, right? He watches and follows the micro movements of the market through the day so that he can alert professionals as to the changes that are likely coming quickly before they do. That's pretty key, right? You have to know some of the leading indicators that are going to tell you what is likely to follow, and then some of the indicators that exist around it so you have an idea about it. So very plainly and simple, he's a guy that helps us. So that's why y'all should listen to him as far as what his opinions are on what he believes that you should be paying attention to this week. Very simple.
Very good. Very good. Great way to put it. So where do you want to start this morning, Christopher?
I'm never for sure the best way to pick apart kind of what goes on in the rate market. So I think timelines are very simple. I'm going to try to do this like a way that a dumb jarhead would understand it. Show me or talk to me about this week what's going to go on chronologically that will happen and occur and inform your opinion on what's happening with mortgage rates.
Awesome. Nathan, would you mind sharing my screen and we'll start there then? So what I've got on the screen, everybody, is the economic calendar for the week. And you can get the economic calendar in a bunch of different sources. You can get it from Yahoo News. This particular one is from the Wall Street Journal. So this is all public information, and you don't need to know all of the finer points of smaller reports, but there's a few larger reports, and they're very well covered here on this Wall Street Journal economic calendar. So let's talk about what's on the economic calendar this week and what effect that these reports or activities may have on mortgage rates. So there's nothing actually going on today on Monday. So that's a quiet day and nothing that we should see that's too big. On Tuesday, we get some housing data, which is the U.S. new home sales. And new home sales are specifically that. They're not new homes as in it's the first time you're buying a home, but they're homes that are built for the first time. And new home sales are expected to pick up in September, following the path of existing homes. So existing home sales have been ticking up recently. And home sales are definitely important to watch for trends. It's important to watch for pricing or what you're going to pay for a house and where the market is, the housing market is overall. But it's the report this itself is not going to have much of an effect on mortgage rates or pricing. It doesn't affect the underlying indicators, the underlying factors, which we'll talk about and explain to everybody if you'd like. But so Tuesday, we've got the new home sales, nothing really that we have to worry about there. On Wednesday, they've got manufacturing data, what they call durable goods. So when you buy that new house and you need to put a washer and a dryer in it and you go, dang, man, that washer and dryer is expensive. That's your durable goods. And durable goods have been getting more expensive because of all the same reasons that everything else has been growing more expensive. There's factories that are struggling with the labor to build it. They're struggling to get the materials in to build it. And they're struggling to get the built items into the country. So all of those factors driving up the cost of durable goods. And as far as mortgage rates go, generally when durable goods are going up in price, that's something that's going to heat up the economy. And that's generally going to put everybody in a position where they think that mortgage rates are going to need to go up a little bit. So it doesn't have an immediate effect, but it does play into the larger picture that we would see rates that are at least not going to go down if it doesn't cause them to tick up a little bit. On Thursday, you've got some overseas data, and generally we are in a global economy now. So it's important to note that it's not just what happens here in the US that we have to watch, but we also have to watch what's happening across the globe and with different central banks especially. So we've got the Bank of Japan, and they're expected to review their growth and inflation forecasts, and our investors will be watching that. And the reason that's important is that our investors, they buy the securities on the back end that basically, form the basis of where your mortgage rates are. And so our investors will be watching to see how that works out. We've got some Eurozone inflation data. The Eurozone inflation has risen at the fastest pace in 13 years. So just like here in the US, where we've seen inflation as an issue recently over the last few months, they're seeing the same thing in the Eurozone and basically across the globe. And then also on Thursday, we've got U.S. gross domestic product, our GDP, and growth. This will be the first of three that they come out with. So what happens with GDP data is they give it out there, then they refine it, and they spit it out again a few weeks later, and then they refine it and they spit it out again. So it's actually the same data. It's just that they've gathered more information and more data to refine the report. So this will be the first of the third quarter data, and it's expected to see that the gross domestic product will come down from the second quarter. And if we see that, that'll help mortgage rates to stay low. Again, it's not going to have an immediate effect that day per se, but the idea that if the economy is running very, very hot and things are going up, that generally is going to bring mortgage rates up with it. So if the gross domestic product is cooling a little bit, that should help keep rates in check. And then on Friday, we've got the Eurozone economic output, which won't have really much effect at all. And then we've got what's called consumer spending. And consumer spending is a very important report. It doesn't get a lot of press, but consumer spending is what drives our U.S. economy. And the higher and more consumer spending that we see, again, it's a sign of economic strength and recovery, especially after the pandemic and through the pandemic. And that's going to be a sign that would pressure mortgage rates if we see strong consumer spending. So if you're looking at those reports, you may not see an immediate change to mortgage rates that day, but you can often see at least some movement. And then you want to see how they play into the larger trend. Is the economy improving and heating up? That's something that will pressure mortgage rates to creep up a little bit higher. If there's signs that the economy is slowing down or just staying a little more stable, those are generally signs that mortgage rates can hang tight.
Cool. Well, I think that gives us a pretty good breakdown of the stuff over the week. So I want to talk, I'll pull it back up for a second though. Sorry. So on Tuesday specifically, new home sales. Talk to me for a half a second here. What's going on with new home sales? I understand that because of COVID, or a lot of people that, went out of work for a while. There were a lot of people that were saving money. There were a lot of people not making mortgage payments, not making rent payments. It was like chaos. And now all of that's gone and everyone's like, no, everyone's good. Defaults are low. Like Logan predicted and projected that, right? That we weren't going to have this cataclysmic event after forbearance, and we have it. Everyone's got stored capital. If we're moving into a period to where economically things could get shaky, what confidence level is there, or what gives people confidence in what's occurring around new home sales, Helmer?
Well, new home sales are going to stay strong because demand is just that much higher than supply. We're still feeling the effects of when everything hit the fan back in 2008 and we lost a lot of the trades and there weren't people to train the next generation of people to build houses. And so we're running into quite a few different issues as far as building more houses. You've got a shortage of labor. You have more regulation and what it's required to actually build a house and where you're going to build a house. People want bigger houses and people don't want multifamily houses anymore like they did generations ago. So there's just simply a lack of inventory on new home sales that is pressuring the prices higher. And on top of that, it costs more to build a new home because labor is higher and lumber is higher, and the home builders, they're looking to make a profit. So they're not making small, affordable homes. And a lot of them, they're making bigger homes in higher price ranges. So it becomes more difficult to buy these homes because they are more expensive and the affordability is a lot lower on them. So the new home sales definitely the number will stay strong because, for no matter what happens with mortgage rates and no matter what happens with where things are, because like you said, there are people with stored capital. There are people with enough money to get out there and buy these houses up and to keep the demand high.
Well, not only do you have a demographic of buyers that are like what, millennials, the 27, 25 to 32, 35-year-olds, that kind of bracket, new housing starts, right? Home formations. Huge demographic of people coming online right now and expected to for the next couple of years, right? But talk to me about when you start talking about demand, right? And how many houses there are to be purchased versus be built. What other investors are there in the domestic U.S. housing market buying up housing against that isn't like the me or you or like just the dude or the dudette buying a house? What's making it so complicated?
So what you're talking about, of course, then is the hedge funds that are buying all of the inventory. In fact, there's hedge funds that are stepping in and buying entire neighborhoods. And as an investment vehicle, they're buying the houses so that they could rent them out. And it's pushing out regular, just me and you type people that are trying to buy a home for our family. And it's pushing them out of the market because you have these large funds that can step in with a large amount of cash and just buy up entire tracts of homes. And they're buying more single family homes than we used to ever see before. And that's a fairly new phenomenon, and it's growing very quickly.
And what's concerning about it, I think, for me, and should be for a lot of other people out there, is the value of a home was typically dictated by what an owner occupant would pay to buy and purchase it, right? There was a supply of housing that was significant enough to cover for the majority of people able to and wanting to purchase a home. Now that that's not true, and you have a demand curve there, it's almost like the value of a home could be determined by what it could rent for and what a hedge fund or someone else could get for cash flow from the thing, almost.
Yeah, very much so. And that's absolutely changing the game. And unfortunately, it's not just driving up the costs of buying a home. It's also the costs of living in one, whether you own it or not. It's pulling rents up. It's driving all home expenses up for sure.
So you mentioned inflation, as we walk through and talk through a lot of that. I think CPI and a lot of other data is coming out that shows inflation, which isn't just as simple as like, just so y'all know, it's not just the Fed printing money. Like there's lots of good things that are kind of tied to inflation as well, right? Demand pull inflation is it's a strong demand market. There's tons of buyers for it. And so the prices rise. That's a good thing in an economy generally, right? When it's like central to housing, you have a little bit of a concern, but with the inflation talks out there, how important is it to own a home when you go through a very strong inflationary period?
Well, owning a home is I think it's pretty widely accepted, even if I can't find a particular source at the moment. But owning a home is generally the middle class's largest access to growing wealth, especially generational wealth. So,
I've got a source. Harvard did a study. I'll give it to you.
All right, yeah. So you guys know what I'm talking about, and you can even source that as some proof on there. So the idea here is that during times of inflation, owning a home is a great way to protect yourself, against that inflation. The worst thing you can do is have money sitting as cash, and you should always have your emergency funds. And generally I think it's about 6 months of your overhead that's accepted to be a good emergency fund. But anything beyond that, you want to start putting it into vehicles that are going to protect against inflation. And nobody ever thought that used cars would actually be a good investment right now. But that's because of the shortage on new cars. That's where there is. But historically, housing is always a good hedge against inflation. Especially as your equity rises, at an even faster pace than inflation. And that's readily apparent now. We've seen, I think Case-Shiller had increases in some cities of up to 20% year over year, which crazy numbers in certain markets. And even in the more tepid markets, it's been, 5, 6, 7% rate, rates of increase in equity in the price of homes. Yeah.
And so, well, actually, I want to ask that question. I want to muddy the waters too much for some of the stuff going on in here. As far as debt goes, though, my opinion with debt, right? I'm a big fan of the thing. I think that especially for veterans with a VA loan out there, that they should be also, and it offers this in a perfect vacuum. Equity increases with or without equity. right? If you have a house with a 100% loan versus a house with a 0% loan, and they're right beside each other, they're the same comps, which one's going to grow rate of equity faster?
Right. They're both exactly the same. Right. Doesn't
Yeah.
matter
So,
if they're leveraged.
so in a market with strong inflation that's coming, why would you want any equity or cash in your house? Would you want any cash in your house with a strong inflationary market in front of you?
It depends on what else you're going to do with that money. And some people want the emotional security. So
Emotional
you've got financial security, and then you've got the emotional security. A lot of people want to pay off their house because they feel better having their house paid off. But yeah, there's a lot you can do with that money rather than pay your house off right now.
Yeah, absolutely. Talk to me a little bit more about Wednesday, Thursday. What's going to be going on as far as really interested with jobs on Thursday. Last week, I think kind of surprised them a little bit. We're in a good situation, but what's going on with jobs?
So with jobs specifically, what you'll see on Thursday, every Thursday we get what are called jobless claims or unemployment claims. So those are all the people that have been laid off that have put in requests for unemployment benefits. You've got new claims, and then you've got continuing claims. And I didn't talk about it. It wasn't actually on this economic calendar. It does happen every Thursday. It's important to watch for the overall idea of where the labor market is. And everyone footnote that idea of the labor market, because we're going to talk about the labor market and inflation for a moment. And we'll dovetail into the Fed comment, and we'll talk about the Fed for a minute. But with the idea of understanding where the labor market is, it's important to know where those jobless claims are. We've seen some really, really what I think is some great signs of life in the jobless claims the last couple of weeks. In fact, last week it fell below 300,000, which is a key number. Before the pandemic, jobless claims were below that 300,000 threshold for I want to say it was just at least well over a year or two. Could go back even further than that. And it was very important to see that things stayed underneath that level. And so once the pandemic hit, of course, people were laid off, and that was when we saw huge unemployment benefit spikes. The other thing that happened is that the government changed the parameters. Normally, in order to collect unemployment, you had to have a job that paid into unemployment insurance, because that's what it is. It's actually a form of insurance. And so you had unemployment insurance, and that's what your employer would pay a portion, and generally the worker pays a small portion. And then what happened is the government said, "Hey, we're not going to just hold this for normal people that are able to go ahead and put in for these claims. We're going to open this up to what they call gig workers, people that were Uber and Lyft drivers, and we're going to open this up to real estate agents and self-employed people. And normally these people aren't eligible to receive these benefits." So it was a huge stress on the economy and a huge stress on the unemployment system. And finally, all of that's now coming back into normal. In early September, it was, in fact, I think it's funny because I think, isn't it Labor Day that's on September 6th? Yeah, that's what makes it such a kind of a beautiful thing. Is on Labor Day when we celebrate labor in America, when what they call the extended and expanded unemployment benefits finally expired, and we went back to normal unemployment benefits. So this week it will be looking to see if it's the third week. I think it's the third week in a row that we will hopefully see that unemployment benefits go down, meaning there's less people that are being laid off. That means that employers are working hard to retain the staff that they have, and they're also hiring. And we see that in a lot of industries. It's very easy to see in retail and fast food. You see signs everywhere, but there's a lot of industries that are hiring, even in I want to say higher level jobs that pay more. There's a lot of industries that are actually still hiring now and trying to bring people back. So that's definitely an important one on Thursday. Did you want to talk more about that before we jump over and talk about employment and the Fed, and kind of this week being the week before the Fed meeting?
I saw something really interesting I'll bring up on the Fed on Facebook this morning, actually, of all morning. And it was a picture of, I forget the dude in the meme, but he's the one that says the jot that down thing. He's like, well, first of all, they're not federal. And second of all, they don't have any reserves. So you may want to jot that down. I thought it was pretty funny. So,
yeah, because the Federal Reserve is actually our central bank. They're not part of the government. They're overseen by the government, but they're not part of our government. They're actually our central banking system, which that's a whole nother rabbit hole to go down and try to explain how that works. And they're designed to make sure our banking platform stays solvent and stable, which they do a pretty good job with since 2008. But generally, so what's that?
I was saying, then go right into it. Yeah, hit them up.
Yeah. So the Fed has been the big player in mortgage rates for the last 18 months. And the reason for that is something called quantitative easing. So when the pandemic hit and the economy went into a state of flux and nobody really knew what was going to happen, the Fed wanted to make sure, and they're responsible for making sure that we don't run into a liquidity issue. We don't have a problem where, our banks fail. So they injected a lot of money into the system. And the way that they did that was by buying up, one of the ways. They did it in many, many ways. But the one we're going to focus on is they did it by buying mortgage bonds and treasuries. So these are on the bond market. Nathan, do you want to go ahead and just show the chart for a minute? I'll pull this up and we'll show. You can see it real clearly here. All right, so this should hopefully look like a lot of confusion to most of you that are looking at this. So let me explain it for you, and then we'll kind of go back to where we were. So if you look at this is called a Japanese candlestick chart, and each one of these little tiny lines is called a candlestick. And the reason they call them a candlestick is because they kind of look like candlesticks. There is a top thin line, which is called a wick. There is a fat section in the middle, which is called the body. And then sometimes there is a section at the bottom, which they call the tail, this little thin section that's a tail. And we could go into what happens to cause each of these, but what you really want to kind of walk away from this is that the overall trend, what kind of a line do they form? And in fact, what I'll do is I'm going to, using this wonderful service called MBS Live, I'm going to go ahead and show you guys with a line chart. We'll get rid of those candlesticks and we'll use a regular line so you can see kind of a larger pattern. Now, what we're looking at here are what are called mortgage-backed securities, and these are the foundation for mortgage rates. These are what your lender is going to have to put on top of that and figure out what is their profit and what do they need to make and their costs of doing a loan. But everything's going to come back to the foundation of what those loans are being sold for on what we call the secondary market. And specifically, if we go back and let's do a 5-year, which this is obviously a very long time. So we look at the beginning of the pandemic, which was right around the early part of 2020, and you can see that there was a big change in things in 2020, and we saw a big jump up in 2020, and that is what helped to bring mortgage rates down. And when I say that this went up, what I'm talking about is the cost of these mortgage bonds. They got more expensive to buy, and that actually brings mortgage rates down. So we'll just kind of keep that relationship there and talk about why that happened. The reason this happened is because the investment world was very afraid of what effect the pandemic was going to have on the stock market, on equities, and where they were going to protect all of this money. And as a safe haven, as they call it, investors will take their money and put it into bonds, which have a much lower rate of return, but are guaranteed. And in fact, treasuries are guaranteed by the U.S. government. So our government would have to fail and not pay its bills in order for treasuries not to be paid back. And mortgage-backed securities or mortgage bonds are also guaranteed right now by the U.S. government because of the way things are laid out. And they're very, very safe. So they have a lower rate of return, but they're a very safe investment. And most investors are going to move in that direction in times of chaos so that they can protect until we kind of saw where things settled out. So what happened is that the Fed also needed to step in and make sure that we were going to keep liquidity in the system. And they wanted to keep the economy moving and keep it positive during this crazy time when the pandemic started. One of the ways that they did that is they started quantitative easing, which they hadn't done since 2008. And they had stopped in 2013. They did it for close to 5 years. And I'm sorry, it might have been late 2008, 2009 when they started. So anyway, they did what's called quantitative easing. And what they're doing is they're actually buying up the market, and they're buying these treasuries. They're buying mortgage bonds to create a demand so that there would be someone to sop up that supply. And what that did is it kept the housing market moving because banks could create mortgages and they could sell them on this market, and the Fed would guarantee by buying up the market that somebody was there to buy this inventory. And that's what really gave a a great boost to mortgage rates. It's why we saw mortgage rates drop to record lows through the pandemic, and why it's been such a great time to either refinance or buy a home. So where we're at now, the Fed is 18 months later or 20, give or take, and they're trying to unwind this. They're trying to now move out of this market, and everybody is watching the Fed because the Fed is performing something which is called tapering. So up until recently, the Fed has been buying at least $80 billion of treasuries every month and $40 billion of mortgage bonds every month. And just recently, the Fed has come out at the last Fed meeting, which runs about every 6 weeks, and they said, okay, we're going to start reducing the amount that we're buying. And they're trying to make sure that the markets know this is coming, so there's no great surprises, no big jumps in interest rates caused by it. And they said, so we're going to start doing this. We want to wind things down by the middle of next year. So that's what's currently priced in. And that's where we started to see mortgage rates creep up a month back, is because investors were preparing for this tapering that the Fed was saying that is going to start coming. Nobody waits until it actually happens to start seeing, investing differently. As soon as they catch wind that it's going to happen, they're trying to get in front of it. So they invest differently. So this week is what we call a blackout week for the Fed members. So the Fed officials, there's all different members. There's presidents in different sections of the country, and they often will have speaking engagements, and they share their opinions, and they talk about where they think things are going and how they're going to basically vote at the next Fed meeting for the voting members, and what they want to see happen in order to make sure that there's no manipulation on anything. They go into a blackout about a week before the meeting, about 10 days before the next Fed meeting, when they release all that information. So normally markets will react to things that the Fed members say. This week, we don't have to worry about that. There's a blackout on Fed members. They won't be speaking to the press. They won't be in any speaking engagements. And what we're waiting for is next Wednesday, which is November 3rd. That'll be the conclusion of the next Fed meeting, and the Fed will release what they call a policy statement, and then we'll have a press conference with the Fed chair, Jerome Powell. And between that policy statement and that press conference, that's when we'll find out, okay, does the Fed plan on starting to taper or reduce these bond purchases? That's going to be the first thing that's going to affect rates and pricing. And then the second thing is when are they going to do it? And it's expected that they're actually going to start in November, and that they'll announce it at this November meeting. And then the third thing is, what effect is this going to have on when the Fed may have to raise interest rates? And when we say raise interest rates, the Fed doesn't have a magic wand and raise rates across the board. They actually only need to raise one rate, and it's their own policy rate. It's called the Fed funds rate. And it's actually the rate that banks have to pay to lend each other money overnight. And you say, well, why are banks lending each other money overnight? And that's because they have certain requirements on what capital and assets they have to have based on, how the bank is set up and the deposits and what money they have out and what's being invested. So it's definitely a complex system. But the Fed can use that one single rate, and that rate will raise or lower and kind of have an overflow on lots of different rates, car loan rates and home loan rates and equity lines of credit rates. And the prime rate is based on the Fed funds rate. So all these different rates are actually based on or affected by when that Fed makes a change. And as of right now, the Fed funds rate is between 0 and 25%. So they actually use a small window. They don't have an exact number. And the investors are looking at, the Fed has taken step one of reducing quantitative easing and reducing these bond purchases. So now step two, to kind of get the economy back on track and to keep inflation in check so it doesn't get out of control, would be to go ahead and start raising rates. And they nicknamed it liftoff. They call it liftoff right now. And everybody is going to be looking to see if they can get any information on when is the Fed going to start taking action. And that's why all this inflation talk is so important, because when inflation is right up until recently, inflation was considered what they call transitory, meaning the Fed knew that we were going to see inflation. They knew that these supply chain issues were going to cause, some prices to go up. But what's happened is there's talk that inflation may not be as transitory as everybody expected, and that it may continue. And in order to keep inflation from going too high, the Fed will need to step in and use the tools that they normally have available, which are to go ahead and start raising that Fed funds rate and slow the economy down. So we're at a crossroads now over the next 6 months where everybody is looking at what action is the Fed currently taking, especially when it comes to the quantitative easing and bond tapering, and then what action do they think they're going to take next as comes to rising rates. And all of that has a very, very big effect on mortgage rates right now, and that's what's actually moving these. So if we look back over the last few months, we can see that this is actually inverse to what you would see with mortgage rates. So the better and the higher this chart goes, you generally see better and lower mortgage rates. And then as this chart goes lower and the cost of these bonds gets less, you actually see slightly higher mortgage rates. And that's why we've seen since early September here, you could see that we have seen this chart going down, which means mortgage rates in that time frame have been creeping up. And it's likely that this week we'll see things kind of settle in. Probably won't see too big of a movement in rates this week ahead of that Fed meeting, but next week we could see another jump depending on how investors react and what the Fed actually says and does on that meeting. So sorry, that was a long one, but anything you want to ask or talk about?
Yeah, I got a couple of follow-ups. Solid on that one. So it sounds like the Fed has a couple tools that they can use to encourage the market or to soak up or get in front of some of the inflation that they believe is coming, and the inflation specifically from monetary policy or inflation from super strong, ridiculous demand in the market or short supply. It's just around the concept of inflation to the commodity of money and what they're really impacting, correct?
Correct. And inflation, again, this one is above my pay grade. I have to really dig in when I start talking about inflation, and you see these different variables and what long-term effect that they'll have on that. We've got costs of energy and food, which is usually volatile. So a lot of times they'll measure two inflation numbers, one that has what they call core inflation, which removes energy and food prices, and then one that has the energy and food prices in it. But the other thing that's factoring in, you mentioned monetary stimulus, and then there's also fiscal stimulus. So monetary stimulus is I always get these backwards. Christopher, you may have to help me on this one. So monetary stimulus is is Fed when the Fed makes manipulations to the market and what they're using for stimulus. Fiscal stimulus is when it's from the government and they're injecting money in, like when we had the CARES Act and other forms. So I may have those backwards. Does that sound right to you about the monetary and fiscal? I always have to look that up before I talk about it. I should have done that.
Fiscal, I think, is the government consumption.
Right. Fiscal is when the government puts it in. Monetary stimulus is when the Fed is injecting the money and the liquidity into the system. And then the other thing about inflation is there's a wage inflation. So what we've seen happen is because of the labor shortage, and we've whatever you want to argue that caused it. There's been arguments that it was expanded unemployment benefits. There's arguments that people can't go back to work because their kids aren't in school, or that a lot of daycare and childcare facilities are not open or are only open part-time. So all of this together, though, has made a huge labor shortage, and that's driving up the cost of wages because supply and demand operates in the labor market as well as anywhere else. And if employers need more people, they'll pay more to get them. And wage inflation tends to be a more permanent inflation, as far as I understand it, at least, because once you've increased this income, and now that you increase the cost of goods because of you have to pay for these extra wages, and it kind of has unfortunately, one overflows into the other. And we may see supply chains ease up. We may see where this chip shortage on vehicles gets better, and we can see more trucks on the road, and we can see more ports that are open. That will improve. But once the wages start to rise, that wage inflation is a more permanent inflation. We're not going to see that as transitory. It's not going to drop back down.
Right. So wage inflation is actually something that is a good thing for the individual to a degree, as long as it's keeping up. And it's kind of, as far as wages go, well, I say wage inflation. There can be circumstances where it's probably a bad thing too, but wage inflation specifically post-pandemic has been one of the things that I've heard argued has trailed as far as recovery. The workers themselves haven't received, and I think John Deere's on strike right now, right? Like 10,000 of their workers because of that, right? Workers are wanting to see their wages go up since record profits and companies have been doing a little bit better, especially over the recent future. But I
Right.
want to talk to everyone out here real quick. That's active duty, y'all. Everyone, when you hear the word inflation, it tends to have a negative connotation to it, right? And we all think about it as a negative thing that the government caused. And it's not that they don't have to do with maybe some of all of it, right? But I want you to think about inflation slightly different too. I want you to think about 9 millimeter rounds over the last 18 months, right? And those things got expensive. Why did they get expensive? For lots of different reasons. The Fed doesn't have a policy on what it produces as far as 9 mil rounds or what it buys up in the market on 9 mil rounds, right? Or what the value of it is when they loan it to the different ammunition companies, right? It's simply a supply demand kind of a thing. It works off of what supply's out there and what demand's out there to a degree. And then regulations can impact it too, which we saw, I think, in a lot of things. But there can be drivers to inflationary drivers that aren't negative necessarily. Inflation is something markets should naturally, the words kind of grow would be the better word, but there are aspects to what they describe inflation as that aren't just simply negative things. A strong demand market's good, but you have to make sure the supply market backs it up. So in a monetary inflation situation, that one may be bad because it impacts everybody without necessarily doing anything. Your money's just going to be losing value while you sit there. So I think inflation is important. I don't know the ins and outs of it perfectly. I have a couple of other guys I'm going to get on here to talk about economic policy, and you know some of them as well as we move forward. But I wanted to have you on here specifically to talk about mortgage interest rates, right? Let's keep this thing super simple. You said you think quiet week this week. Overall, we've been following a trend of interest rates moving up. The first day of the week that you think things could get a little bit movement-y, if they do this week, what day do you think it'll be and why?
So if things were to move around a little bit, as far as economic data, you would see that it would probably be the consumer spending on Friday that would have more of an effect than anything else. Otherwise, there's a bit of a vacuum. It's only if you see if depending on what's going on in the stock market and equities, that'll overflow into kind of some movement. So we will always see a little bit of movement each day, but we shouldn't see any big jump in rates. And if we do see any movement, it should be towards the end of the week with that consumer spending and the GDP data.
Cool. So quiet week. A lot of vets, anyone out here looking to lock a loan or get into a mortgage this week, they don't have to stress out crazy that something's going to happen midweek that's going to blow everything up and cause their rates to shoot up this, that, or the other. There's a lot of fear out there. I've had friends of mine asking me, hey, you know where I can lock a rate 6 months into the future, right? And so all of this inflationary talk and interest rates going up for the last couple of weeks, 3 weeks, right, has consumers concerned with locking that far out. Do you think it's prudent to lock for 6 months?
Not for 6 months. It's especially most investors, most lenders can't lock out that far unless there's certain new construction loans. Otherwise, generally about 60 days, 2 months is going to be your cap. And it costs more money to guarantee a rate that far in advance because none of us have a crystal ball. So the movements that we've seen, if you look at it in a midterm trend, meaning over the last month, it's been a creeping. Unfortunately, though, creeping kind of it's almost like a movement of a slinky where it's kind of slow and then it'll drop down real quick and into that next step before it falls over itself a little slower. So we see those steps and movements where rates kind of jump up in a day, and you're like, "Hey, what happened?" But when we look at it over the course of weeks, they're slowly creeping up, and we're probably not going to see rates go too much higher until there's more talk of the Fed raising rates. And that's what all the investors are listening for. And that's what will ultimately kind of affect mortgage rates. I think the markets have come to terms with the fact that we are seeing what we call the tapering in the bond market, where there's a reduction of the Fed buying. And we'll see, as long as the markets continue to kind of look at that in the same lens, and they don't think that that's going to lead to a faster rate increase, we should see mortgage rates stay relatively stable, maybe go a little bit higher, an eighth of a point, maybe even a quarter point. But overall, you're going to see a little bit of up and a little bit down. The mortgage rates are always cyclical. They tend to go, up a little bit, down a little bit, up a little bit. And then there's the larger trends where you see the bigger movement. I don't think that we have to worry about between now and the end of the year seeing any big rate jumps, but we definitely will see certain windows where you have to be more careful than others. This week, I wouldn't worry about seeing rates jump, but you definitely do want to talk to whoever you're working with and find out, there's usually better opportunities to lock in than others. If you are looking to lock in for 60 days, talk to your, mortgage professional and about the benefits to that, or Christopher, anything that we can give them insight. That's going to cost more to lock in for 60 days. Would it be advantageous? It's not necessarily. We won't know for sure, but I don't think that you have to worry about it. There are times when you say, yes, definitely lock those loans in, because it's very likely we'll see rates higher in 60 days. I don't think we're going to see rates too much higher in 60 days at this point.
I think the consumer belief is that if they lock for a long period of time it's backwards here. So from here to here, if they lock from here to here, right, then they get ahead of the increase that's likely coming. But what I think that they miss out on a lot of the time is when an investor offers a lockout that long, it's already priced in. If they think it's going to go up, it's already priced in. A new home build, one-time close type loans, right, where they're fixing the interest rate a year or so in advance of when the permanent loan is going to be done. Don't think, consumers, that just because you're locking for that period of time that you're getting in front of all of what you think may come there. They're going to be pricing in, correct me if I'm wrong here, Helmer, but they're pricing in an expected adjustment. That the same reason that that you may want to consider locking for longer periods of time, they know also.
And so they're putting in a premium on there. Exactly.
Right. So more likely than not, if you, let's just say 6-month lock, I get that it's not exceptionally common, but 6-month lock, more often than not, do you think the consumer or the investor would come out ahead on that average? We need to look at some data.
Investor, I think the investor does for sure. Yeah,
they spend hundreds of thousands of dollars on employees just to track these things and know exactly where to tag them. So at the worst case, they break even maybe, or they come out a little, not break even. They're not trying to break even. They come out a little bit ahead. Best case, they crush it. The market falls, and now they're way ahead, and they get to refinance people.
Yeah, and it's even more complex than that, because there's actually certain insurance policies that they take to make sure that they don't get caught out on interest rates on those loans, and that's going to cost the consumer. It's not an insurance policy like a term policy that you take on your life, but there's certain insurances that they take and things they invest in to counteract that. So yeah, absolutely. The shorter the window, the better that it's going to be for the consumer, is always the case.
Awesome. I think that's a good point to point out, because I think a lot of consumers are afraid right now. I think they're fearful of this word inflation. They're fearful of interest rates and where they may be moving to, right? All of this stuff it's hard to understand, first of all. I've been following it for years. So have you. It's, I don't know who understands it all perfectly, because there's not some recipe or formula that works the same each and every time, guys. This is hundreds of millions of people in an economy moving together, spending, buying, purchasing, right? And those things create impacts that you can't measure perfectly every single time. So vets here, active duty here, what we're going to promise to y'all is Helmer's going to be around pretty regular now. We're going to be having some discussions on mortgage interest rates and some movements and things periodically, just to make sure y'all have value coming to you. But I'm bringing around a couple of other people to discuss some economics as well. But these are people I've followed for a long time, and I see the evidence of their actions in my industry and how they're supporting professionals. They're not people that are in any way, their businesses, their platforms, Hammers, right, or anyone else's, they're not geared towards consumer consumption. So a lot of the times, these topics are going to be a little bit difficult, right? They're already complex. Professionals don't understand them perfectly. And our goal is to slowly walk back some of the things that may be confusing about them. I want y'all's participation here, because I want you learning. I do not want you using emotion to drive your financial decisions. Earlier, you heard Helmer say that people have a better emotional feel when they pay off a mortgage, right?
Right.
A free and clear house is a farce, y'all. Taxes, insurance, maintenance go on forever, and they always increase. And those three are probably getting pretty close to the cost of a house itself as far as a mortgage payment goes, right? And so that's just something to keep in mind, right? It's not like you're ever going to get out of being obligated to making payments to this thing if you want to own it. You're going to have to make continual payments, and you need to make those in an uninterrupted manner, right? And so that is where your security should lie. Not in the emotionality, comfort of certain things, but the fact and math behind them, especially when you get into subjects like mortgages and interest rates, investing and finance, right?
Yes. Yeah, I was waiting for a gap there. Christopher, the one thing that I think you hit the nail on the head is people never think like they're going to make a one-time payment and pay off their electric bill for the rest of their life. You know that you're going to pay for electric as you consume it. And you're okay having an electric payment every month because you need to. And I think that housing is the same way, but we don't necessarily realize it. So that's a great way to put that out to everybody.
Well, what I saw, and this is a takeaway for everyone out there, if you have a grandpa or a grandma that's lived a long period of time, here's my grandpa's circumstances. This is what I'll leave everyone live because it's a really important takeaway. My grandpa retired in like 89, 90. They built a house free and clear, spent about 100 or so, 120, I think, building it. Had a good sum of money saved up, more than that, actually, from his retirement. He served in the Army, Korean War, and then he carried mail for the post office for 30-something years. The guy walked. Carried mail on foot for 30-something years. Paid off his house, paid off a lot of other bills. He is 88 now, 88, 89 now. He turned 89 this year. And he's out of the house now. My sister and I are purchasing it. But he lived to the point to where what he'd done to set himself up for retirement, mid-60s, and where he was in the beginning of 90, the money that he had saved and everything he had set aside has existed so long now that it's really not even a significant number anymore. 100 grand in the 90s, 1990 versus 100 grand in 2021, huge difference. The irony being his house flew way past his savings and growth. He took himself out of the economy of money, out of growing his money, right? And he went and played a complete defensive strategy. This is like playing Monopoly and never purchasing a house at all, just renting and saving your money, right? And so he lived to a point to where the savings that he had to secure his house became worrisome when he outlived his dollars, right? Because taxes, insurance, and maintenance, even those taxes froze at a certain age, right? They froze at a high number. And so the carrying cost of a house itself becomes difficult, even when it's paid off, because he got out of the growth economy of money itself. And that's what I'm worried that too many people are out there wanting to do right now. They're like, hey, I want to pay off my house. If you use today's dollars to do that, you're robbing yourself immediately because your asset's going to appreciate the same or not appreciate the same regardless, right? And you're guaranteeing by using today's dollars for the purchase, if tomorrow's dollars are going to be worth less, that you're devaluing your money today, the first action that you're doing there. And that's not to say to pay off a house or not to put money down on a house. I'm saying it should be a mathematical, a financial decision and not an emotional one. I see far too many people making emotional financial decisions that rob them.
Very good.
My little tidbit. Hopefully all of this was valuable for people today. I think that you, with what you've kind of given us as far as what to look out for the week, changes, that's solid. Pop back in. I'll probably hit you up if something starts happening this week and we want to give them some midweek adjustments or anything else. But you're in the community now, I think. Nathan's put you in the community now. So as you have things, takeaways, values, explanations, we can chat on them and we can share them some here. Veterans, if you have questions, ask Helmer. Simple, complex, whatever they are, our goal here has always been the same. We want a community where you can come in and ask any question and get an honest answer to it without being hit up for business or cussed at by someone because they didn't like how you phrase something, right? We're a source of human intelligence for you. A lot of veterans here lately, they think that we exist just to provide professionals for professional services. That was never the case, guys, ever. It's the number one thing I didn't want this place to turn into. You demanded that you have access to the people that I vet continually so that you could ask them questions. And sometimes you demanded to work with them too, which I get. But I do not want you thinking that this place was created simply to drive your professional services to them. It's not. This place was created as a human source of intelligence. Human intelligence in the military is the only intelligence form that answers the why for the commander. And when you're buying a home, why you're doing what you're doing is one of the most important things that you need to figure out, because your plan needs to be long enough, especially with a home, to make it the most valuable decision that you're making. So Helmer, thanks for your time this morning. I know we went a little bit long, 48 minutes on race and stuff. I bet you like 8 people watched this, but those 8 people should be pretty well informed, I think.
There you go. Well, thank you for having me, and I'm sure we can tighten it up as we do this more often.
Yeah, we can. Let them stagger through it if they want to. There's stuff in there. There's value in there for everyone. We'll try to make these a little bit more entertaining. Veterans, if y'all have questions that come up, make sure that you ask them on the post. We'll flirt around and answer them for the rest of the day and into the week. But I hope y'all have a blessed week. I hope you have an informed week, and I hope you make financial decisions that empower you, your family, and change your wealth prospects for the rest of your life. Blessings, y'all.
Take care.